All right, welcome everyone to the first edition of Plena Wealth Advisors podcast. We are joined today, myself, Jay Snyder, here in Vancouver. We've got Clark Linton around the corner in Vancouver as well, and Craig White up in our Kelowna office. Our purpose of this podcast is really to disseminate some information to clients in a new medium that has obviously become quite popular over the years, give you a little bit of insight into how we're thinking as a group here, our thoughts on the market, the economy, our portfolio management strategy, and other topics that are relevant to our clients. We'll try to keep it fun, short, interesting, and of course we welcome any comments that you may have at any time. You can reach us obviously through email, phone calls, the usual channels. Without spending too much time, you're probably familiar with one of us as your principal advisors, some of you with a few of us, but the three of us have been working together now for a little over 6 years, and we've more formally combined to form an entity under Raymond James umbrella, and that entity is called Plena Wealth Advisors. So here we are, and this is one progression of our platform that we hope will add some value to our client relationships. So what we're going to try to tackle today are three kind of topics fitting nicely. Here we are, lucky January, Friday the 13th. The year's just wrapped up, and we've got some reflection to do, some looking ahead to what we can expect here in the next 12 months. And so we're going to touch on a year in review. The topic also on everyone's mind is inflation and what's going to happen there. And then we're going to talk about recession, no recession in the year ahead, and wrap things up with a couple of predictions that we'll put forward. And hopefully a year from now and many podcasts under our belt, we can look back and see how we did. We're not in the business of making 12-month predictions, but maybe we can have some fun with that and see if we can use our crystal balls and test their accuracy. So hopefully, again, it's interesting, light, fun, and we can have a good little discussion here. So for year in review, 2022 obviously was a year that set some records in some not so happy ways, but the economy, the markets were volatile from the get-go. And I think one of the data points that is most impressive and memorable for me was 2022 was the first year ever that we saw a 10% drop in the S&P 500 and the US 10-year Treasury in the same year. The first year ever that happened. Really a reflection of how much difficulty we saw in the bond market, which was maybe the biggest surprise. Craig, what are you going to remember when you look back on 2022?
Yeah, thanks, Jay. Good question. And I'll start off by saying, my apologies for not having the official business attire on. I just flew in from some meetings on the island in Vancouver. So I know you guys are probably giving me a bit of gears for a little bit more casually dressed. But for those who know me, again, normally I'm in business attire. But yeah, I'm very excited to do this podcast. We've done something similar like this over the years, and again, I agree with you, Jay. It's a good medium in which we can relay some messages to clients. So, going forward, we certainly welcome feedback from clients on topics and what have you. So, yeah, I think it's going to be a good source for our clients going forward. But to answer your question, what most memorable? When you look at it, again, I think it's the volatility, I would say, amongst all asset classes. And in the investment business, there's a tendency to look at markets or asset classes on a calendar year basis. And, from our perspective, I think there's some error in that, because first and foremost, when we plan for clients, we don't plan on a January to January type basis. But in this business, a lot of comparisons are made on a calendar basis. And ironically, the kind of peak of various assets, most importantly, kind of stocks and bonds, was January of 2022. And since then, you've seen a pretty significant decline throughout the year in various assets. As you said, in particular, the fixed income market, which has historically been, a less volatile asset class that, is obviously tied to interest rates. And I think that's the second story that was 2022 for me, was volatility associated with asset classes in response to the pace in which central banks raise interest rates. We had 7 interest rate increases from the Federal Reserve out of the US, which you have to go back to the early 80s before you saw even something close to that during the Volcker era, excuse me. And across the board, you saw that with long duration bonds kind of being 20 years plus on duration, we're down, give or take 25%. Medium duration bonds, kind of 10 to 20 year duration, they were down 16 to 17%. Even short duration, 10 years and under, saw close to double-digit negative returns. So not only fixed income impacted, equities, in particular the U.S. markets, the S&P 500, which is broadly followed, down 20%. The Dow Industrial is down 10%. The NASDAQ, which was its top performer coming out of COVID, that was down, I think it was close to almost 30%, 33% or something like that. So, at the end of the day, it's volatility, I would say, the pace of interest rates and inflation. And again, you're starting to see some positive momentum. That's probably later on in this call, but that's kind of my take so far.
Okay, Clark, give us something positive from 2022 that you remember.
Well, I was just going to touch on the negative, but I'll try my best to turn it into a positive. I think what you both mentioned there, just about the performance of asset classes, what's memorable about 2022, it's one of the first years that the cushion that we get in a traditional balanced portfolio in the fixed income space, bonds, et cetera, that would normally provide that cushion as markets fall, interest rates generally tend to fall and provide that catalyst for higher bond prices, which offset that volatility. This was one of the first years in memory where that didn't occur because the catalyst for this market correction was higher interest rates. So a difficult year all around, where really no place to hide per se, that all areas of a portfolio saw some weakness as a result. I think the positive that can come out of that, though, I think that, although we didn't see the pace of inflation or the level of inflation, we didn't see that beforehand as much as, I think the market should have. I think our positioning going into 2022 with the type of companies that we own, low duration bonds, very short term in nature, allowed us to provide as much of a cushion as we could have. So Jay, would you take that as a positive?
Some relative negative performance. Yeah, I'll take that as a small win, I guess. I think one of the things that I think we can be excited about is, we always look at these returns, or, you think about these negative years, and, if you've seen the charts that show you, the subsequent year returns of 1, 3, 5, 10 years out, and when your starting point is in the bottom or close to the bottom of what last year was certainly a fairly significant correction, forward returns are always extremely positive. And obviously got to be a little bit careful using history as a certainty, but looking forward, I think we can get a little bit excited about what's to come, and that might not happen in the next 6 months, but 3, 5, 10 years from now, those that are fortunate enough to be putting money to work into down markets like we've seen over the last year are gonna probably be well rewarded for that timing. So
I think your point is well taken, Jay. Is that, I mean, it's human nature, after a market correction or a year like we saw in 2022, for it's after the fact that people tend to get concerned, question what the long term will look like, question what the next year will look like, and we know, as you say, from history, but just how markets perform is that it's generally that time when we do feel a little bit of despair that those opportunities do exist, and we look back in those times. Generally, that has been some of the best times to put money to work, and traditionally has been times when markets tend to bottom and start their next leg up.
Yeah, and I'll add in, there's a tendency in certainly in the media talk about markets as homogenous. In other words, all asset classes are performing better or worse at the same time. Well, we know that's not the point or the case, because you look at 2022 from a sector side of things. Energy had one of its best years in over 10, 15, 20 years. It was a strong performer, up 40-50%. So obviously those who had exposure to energy, they would say, well, my portfolio performed a lot better than the markets. And because the way that markets are made up nowadays, they're so skewed by the heavy large cap names such as the Apples and the Microsoft and the Amazons of the world, that they're a big directional driver up and down for markets. And we talk about all the time as portfolio managers, it's our job to analyze and monitor the markets and use it as a gauge. But at the end of the day, it's also the job of a financial advisor, portfolio manager, to find out what asset classes or what sectors specifically are working in any market environment or any economic environment. And that's, coming out of this, that's where, as you said, there's lots of opportunity. I agree with you that you've had a revaluation on a lot of these different assets that when you get to almost the reversion to the mean, you're going to see some significant performance on various sectors. Some are just going to continue to underperform.
Yeah, I totally agree. And I think the takeaway is at this juncture, let's continue to look for these opportunities as we have seen these repricing, revaluations of some attractive businesses and companies, and in the fixed income market, certainly the entire asset class as a whole. I know in my relatively short 15-year career, I've never been so comfortable / excited about the potential and go forward opportunities in the relatively boring realm of fixed income. So moving on, I guess, to the topic on everyone's mind. Sitting here yesterday, we had CPI inflation readings come out of the U.S., which again showed a slight continued drop in both headline and core inflation, which we've certainly been discussing that trend here now for a number of months, if not quarters, saying and suggesting that, hey, maybe we have seen peak inflation and maybe it is time to set the expectations that we will see a softening of interest rate increases and a resetting of that course, which has obviously been the biggest driver of asset class returns over the last 12 months. So where we're at today, Clark, I'm interested in your thoughts on what's inflation got in store for the year ahead, and what should we be looking for?
I think it's a great question. It's inflation is a topic that's on everybody's mind. I think arguably that side by side with the war in Ukraine were probably the two biggest news stories of 2022. And in the financial world, inflation by far was the biggest news story in 2022. And I think going back to Craig's point, talking about the interest rate increases from the Federal Reserve, Bank of Canada, et cetera, the rapid increase in interest rates, the primary catalyst for that is inflation. So it really deserves the seriousness that got in the media and amongst the market. Inflation peaked out in June, 9.1% in the United States, and in Canada, 8.1%. Those are pretty significant numbers, and it's worthy of a conversation about that. My own personal view is that what the market is focused on, what the headlines are focused on, it is incorrect. I think there's so many comparisons and so much fear around the fact that, is this going to be the 1970s and the 1980s all over again? We get that from clients. You see that in the headlines, that inflation is here, it's here to stay, it's this danger. And I don't necessarily agree with that. I think the reasons for inflation this time around relative to the 1970s and 80s are far, far different. In the 1970s, inflation was really brought on by a number of factors. I think the predominant one was the US dollar going off the gold standard. When Nixon removed the US dollar from the gold standard, it caused a significant decline, a decade-long decline in the US dollar, which was a catalyst for inflation. We also saw the establishment of OPEC, where for the first time ever, we saw an organization have a price control over such a significant asset or commodity, which put a floor and also the ability for that price control to keep elevated prices. We saw things such as the power of the unions in the 1970s and 80s, which put huge bargaining power for wages back in the hands of the employees as a, at the expense of the employer. This time around, I think it's far different. Those are really secular in nature or long-term issues that caused inflation to run away for the decade or for a longer period of time. I think this time around, inflation is more cyclical in nature. It's really, the way I see it is it was brought on by a demand supply equilibrium, almost a supply shock per se, that was brought on primarily by COVID. And, anytime you have governments and companies around the world closing the global economy for business, supply is going to essentially evaporate. The ability to produce goods, transport goods, bring them to market ceased to exist in early 2020 and lasted for quite a long period of time. In addition to that, demand was taken off the table. People were not out there shopping and traveling. And then as things started to reopen and people had the ability to spend, together with a lot of stimulus from the government, more money to spend as well, you had a huge pent-up demand, and you did not have supply to the level yet that could keep up with that demand. And it's simple economics 101. You have too much demand, not enough supply, it creates higher prices. I think going into COVID or early stages of COVID, we all expected inflation as a result. I think where a lot of people got it wrong was how long the supply shock would last. And COVID still exists today, 3 years into it. Some of the supply chain disruptions still exist. We didn't expect that in early 2020. Up until about 2 months ago, even a month ago, when the Chinese government started to use restrictions, if somebody sneezed in a factory in Guangzhou, they closed the factory for 2 weeks. If that factory was creating parts for automobile production, 2 weeks of production was taken off the table. That whole supply chain for automobile manufacturing slowed down. That still exists today, albeit things have improved relative to where they were 2 months ago, 6 months ago, 12 months ago. I think things such as, the war in Ukraine extended that supply shock. 2 years in to COVID, we had the war in Ukraine. All of a sudden, oil taken off the market with sanctions on Russia, natural gas being used as a tool by Putin, and agriculture products that are exported from Ukraine were taken off the market as well. Ukraine is, for most agriculture commodities, one of the top 3 producers in the world. It was very significant. That all being said, what we've been making the call, we've been having these conversations, the 3 of us, over the last 6 months, that we believe inflation is in the process of moderating. And Jay, you mentioned just a few minutes ago, the numbers that came out did show signs of that. Inflation's now at 6.5%. And if we believe that to continue, some moderation with inflation, we should see interest rates moderate as a result. I believe that interest rates and inflation were the catalyst for this recent correction. I think in turn, we need to believe that that'll be the catalyst for a recovery. I think if we look around, we are seeing prices moderate. Driving to work today, oil at the gas station, $1.74 a liter. I think as recent as last summer, I saw $2.60 at the tank. And we're ultimately going to see some of these commodity price increases start to work their way through retail prices. Something like a Walmart effect, where Walmart starts to cut prices as its cost of goods starts to decrease, and its competitors have to keep pace with lowering prices as well. Things like Starbucks coffee. I think 3 years ago I was paying $2.25 for a coffee. It's $2.65 now. As coffee prices come down, the commodity comes down. We can expect potentially that price of coffee to drop, particularly if a competitor across the road starts to drop their prices as well. I think that the wild card.
Look at Tesla this morning dropping their price by 20%, I think, on all model cars for the year. So that's a huge, big ticket item that's all of a sudden 20% cheaper.
Just another great example of that, and we are seeing that, and I think we'll continue to see that. I think the thing that is the wild card there is wages. And if you go back to your Tesla example, Jay, and you think about Starbucks, it's far more likely that we see the cost of coffee drop from $2.65 to say $2.50, or a Tesla to drop in price. But how about the wages of the people that produce that product or pour that cup of coffee? It's highly unlikely that the barista that was making $15 an hour 3 years ago, and the wages have had to increase to 18, that his or her wages are going to drop back. They're more likely to stay static with less of a magnitude of increases down the road. But, I think there's a lot changing there. And one of the things we've been talking about is, over the last couple of years, partly as a result of COVID, we've seen certain factors really change the conversation that employers are having with potential employees as they're looking to fill jobs, where the power has really been in the sense, or in the hands of the employee. Even now, if a company is looking to hire somebody, it's the employee that's dictating, where am I going to work? What hours am I going to work? What's my job going to look like? This is what I want to get paid. I want to bring my ferret to work if I have to be in the office, things like this. It's really gotten out of hand. And I think what we've been saying is all it's going to take is for a recession or an economic slowdown to correct that. And we're starting to see that. Amazon, which was one of the biggest, one of the companies that was hiring the most people during COVID, just announced a couple of weeks ago laying off 18,000 people. Goldman Sachs, 15,000 people last week. We saw it again with Salesforce laying off people. And I think when we see that, what we're going to see, we may not ultimately see people's wages drop, but the pace of increase, I think, will rapidly slow. Again, this goes back to a supply shock where you had not enough supply of labor and an increase in demand for labor. And I think, again, all it takes is for an economic slowdown to bring that back more to a rational equilibrium.
Well, do you not think then if that plays out, what you're starting to see, as you said, kind of the more of the white collar side of things, you're starting to see employment data impacted there. But from a central bank policy, which I'll speak for myself, I think that was a huge catalyst to inflation, for central banks keeping interest rates, at generational lows longer than they probably should have. And if you go back to the fall of last year, when you did start to see inflation data pick up, remember the word they always used was transitory, right? And I think we can all agree that, well, Powell's even admitted that transitory was likely the wrong word, and they got caught. So now they're caught raising 7 times, as we said. But for them, there's the possibility that they may engineer this so-called soft landing where they bring inflation down, which we saw that yesterday. And again, people concentrate so much on the ultimate, the exact number, it's down 0.1 or year over year. I think at the end of the day, what we want to see is the trend continue to move down. And you've seen that for 6 months now, for the most part. But if they can engineer inflation coming down, yet employment levels still remaining pretty strong, that's the definition of a soft landing. And I would challenge that as, a potential outcome. Maybe that's part of the predictions, Jay, that you talked about. One of the outcomes of 2023 that magically we get through this through central bank intervention, which has been tough. But 6 months ago, the market, and I think the consensus was, we're going into a hard, deep recession. The data is coming out over the last couple of months, specifically last quarter, has been better than that consensus, which is probably why you've seen equity markets start this year on a pretty strong note.
Yeah, I think that's a great point, Craig. And I think it's, it's a good catalyst, and what Jay might want to talk about, which is what we see going forward. But markets are all about expectations. And if the current expectation, I don't think the current expectation is a soft landing. I still think the aggregate believe that we are heading into recession. We may or may not be, but believe that we will be into a deeper recession with elevated price levels, elevated inflation. And if that proves to be, if things prove to not be as bad, that's where markets start to outperform, is when we have a positive surprise relative to a relatively negative expectation.
Yeah.
I mean, I think everyone loves to give the central bankers such a tough time. I mean, everyone jumped on Powell for the transitory comments, and let's define transitory first of all, because if inflation does start cooling off, like we collectively think it will, and it's shown signs of already. Maybe it does turn out to be transitory. It just ends up being a 1 year
Longer
transitory situation. So, they've got a tough job in trying to predict the direction of these, economies and of interest rates and of inflation. And, I think that soft landing that they're trying to be the architects of is incredibly difficult. And, let's give them a little bit of credit. They are, highly credentialed people that have a lot more access to data than certainly we do. And if they are able to execute this soft landing, get inflation under control, get the economy into a place where we can start that next cycle from, certainly the stock market, the bond market will be happy with that, and that should be what we're all cheering for. It's easy to be contrarian and try to call the unelected officials bad names, but at the end of the day we're cheering for their success, not for their failure, right?
Well, yeah, it's I think you can look no further than what's happening in the bond markets right now. As we sit today, the US 10-year Treasury, and Jay, you noted that earlier, that's kind of the most broadly followed treasury or bond globally. Here we are today at 3.51%. That was trading close to 4.5% not too long ago. So market's saying inflation has peaked. We're getting that evidence with the bond market. So I don't think we want to go against what the message is out there. People say, well, inflation's still running high. Well, the market's telling you something different.
Yeah, it's still high, but to your point, the direction is now in our favor, and hopefully that leads to some positive outcomes this year. I just hope that doesn't mean that's the end of Clark bringing his ferret to work.
Sorry, Jay?
I just hope that's not the end of your ferret being brought into work.
I don't think it ever will be at this point, but no, on inflation, I think, the term transitory, I think it is linguistics, is that my definition of transitory, and it's a word that I may have correctly or incorrectly used, as Powell has over the last number of years, that my view of transitory is really short term. And I think whereas a lot of people in the market view transitory as prices go up with inflation and they come all the way back down. That's not what I ever mean, and I'm not sure if that's what a lot of others meant about transitory. Transitory is we've gone through a supply shock, as I said. We've seen an elevated level of prices. That level of prices, of that continued increase in prices, should be shorter term and transitory in nature, not an expectation that all those prices will fall back to their starting point.
Yes.
And don't you think too, as consumers, which is 70% of the economy, it's been a tough inflationary period for all of us, highest I've seen in my life. But is it fair to say that the majority of us, if not all of us, we adjust our spending habits due to inflation? If you're going out to a restaurant and you're finding that tenderloin is 25% cheaper than it was 18 months ago, well, you shift your spending and you're not going out to dinner at restaurant XYZ, and you're spending that money somewhere else, maybe at that home renovations or something like that. So we talk about inflation as we're aware of it, but I think we all adjust to that. And when we're talking with our clients, generally they don't say, well, we need X amount of dollars per month and you need to increase that because I need to adjust it for inflation every quarter. People adjust their spending habits based off of that.
Yeah, I mean, I think that's exactly right. I think that kind of dovetails nicely into this recession, no recession, expectation for the year ahead, where, I mean, I don't know about you guys, but I've never been inundated with so many clients' concerns about the coming recession. That is such a certainty. And, we've got the mainstream media, in large part to thank for that. I mean, every economist, political market pundit out there is, more or less on board calling for 2023 to be a recession. I mean, I think, historically, when you get 2 quarters of negative GDP growth like we saw in 2022, I mean, that's been the old definition of a recession. This time it hasn't been declared as such by the Board of Statistics or whoever makes that claim. But the next year where, Craig, you sent out that link to the kind of big bank, forecast for the year ahead, and across the board, everyone is expecting a recession. That's the baseline expectation, is that we're going to see economic contraction in large part, like what you just said, where everyone's adjusting their spending. Everyone is tightening their belts, maybe spending a little bit less on vacations, on dinners, on those extracurricular activities and spending that they otherwise can curtail. So with that pullback in spending, yes, of course, we're going to see, especially year over year relative to, the benchmarks we set at the reopening of the economy in 2021 and then followed through, in some degree in 2022, we're going to see a decline. And, I think the market is prepared for that. I think, Clark, to your point earlier, it really isn't so much, are things bad or good? It's, are they getting better or worse? And with the market now expecting a recession, again, pretty much universally, the market is prepared, people are prepared for a recession. And if there's anything that's turns out to be just a bit better than expectations, I think you could see us set up for a really positive year in markets. And I think that's something that, most investors don't have on their, high probability of outcome list. Everyone's focused on what's going on in Ukraine, how terrible the energy situation in Europe is. And I mean, thank God that they're having a relatively mild winter right now, which is certainly helping things along. The political fighting in the US, the myriad issues that are out there that, are causing a lot of pessimism. If there's anything that surprises us on the upside, and it doesn't take a lot of thought to come up with a list of things that could surprise us. I mean, you've got China, where the second largest economy is coming off of, the most draconian lockdown that the world saw. And, 1.5 billion people coming out of this, hopefully in the next kind of weeks or months here, they're going to want to spend money. They're going to want to go on vacation. They're going to want to go back to restaurants. They're going to want to travel. So, you've got that whole demand pull that's going to have an impact on the economy and on markets. And it's not hard to imagine how that may, offset a lot of the Western, rest of the world, pullback in spending. And all of a sudden you've got a global economy that turns out to be not so bad, which, recession, no recession, as long-term, allocators of capital, in our view and from our previous conversations, doesn't really matter if we see a recession this year or not. Of course, we're concerned about, the economic environment. Of course, we're allocating assets to hopefully protect capital where possible. But, if we're looking at a high quality business that generates high free cash flow through good markets and bad through good cycles and bad, the opportunity to buy when prices are low as they are today, almost across the board, it's a great time, investing, like I mentioned earlier, the go forward numbers, typically the best time to be investing is during down markets, whether that corresponds with the recession or not, is somewhat irrelevant. It's semantics to a degree, but I think we don't want to be cheering on a recession, because obviously, what coincides with that is typically job losses and unemployment spikes. But, the potential is there for some upside surprises on the economic data. And, that's something that, as, investors in equities, you don't want to sidestep because of your fear for the worst case scenario. You can't invest long-term with the concern that, hey, the Ukraine war might get worse. And, that hopefully a very low probability outcome is something that we're, obviously, trying to avoid, not from an investment standpoint, from an investment standpoint, but also just from a humanitarian standpoint. But we've got to be allocating capital in businesses and in opportunities that we know will persist through whatever geopolitical conflict is around now and will come next. So what are your calls? I'm not going to say I'm calling for an avoidance of a recession. I think again, the economic contraction is the baseline expectation. But what do you think, Clark? Recession?
I agree completely with you, and that may be the first time. But hopefully won't be the last time either. But no, I think it's very well said, Jay. I think going back to what you mentioned about the document that Craig sent around internally that we've been discussing amongst our group, the economic forecast for almost every firm in Canada on Wall Street. They're all calling for a recession. That is the baseline scenario is a recession, not just an economic slowdown. And amongst those forecasts, you have levels of this and you have levels of that. And I think I'm not going to make a call on whether we're going to be in a recession. We may already be in a recession. I think my view is we're in an economic slowdown. The consensus may be too negative, given some of the potential catalysts, given, again, inflation being the primary catalyst for this correction. We're seeing very obvious signs of inflation moderating. Your point about China, this whole new level of demand being brought to market where it hasn't been over the last couple of years. I think we have significant room for positive surprises or things to not be as bad as what the consensus is. So generally, that would be my view. I think very supportive of yours.
Craig, push back. Let's hear the other side of the coin.
No, I as tough as the last 6, 12, 18 months have felt, I agree to the view that the forward outlook is quite constructive for most balanced investors. The economy was running hot, whether it was because of liquidity, supply strains, the sustainability of lumber prices at $1,300, oil at 120, nat gas and copper where it was trading. If it continued to run hot like that, the flip side of that would be, I think you could probably almost nail in a deep recession. Coming out of this, people fear that interest rates have spiked. I disagree with that comment. I think they've normalized. Now you've got mortgage rates here in Canada that are, let's call it 5.5% on a variable rate. An era of sub 2%, in my opinion, that's not sustainable. That, created a real estate market that was overheated in areas like Vancouver or Toronto and even here in the Okanagan. So this normalization of interest rates as we go through recession, softer economic period, I think most investors should welcome that, saying, as we move forward, now you've got an opportunity where hopefully inflation has moderated and you have an interest rate complex that is attractive for the first time since going back to, kind of 2005 to 2007, when bond yields were similar to where they are or were. So painful for sure to go through this, but it's not as if recessions or corrections or pullbacks, those aren't new. I would guarantee that we're going to go through another soft period at some point over the next decade. And we always educate our clients, and we know that corrections and pullbacks, however we want to define them, they're part of that cycle. And we know that, we expect them, but every time we go through one, they always feel a lot worse than the previous one and point to a different input or a different data set to prove that. And guess what? That cycle repeats itself. And I'm going to probably say we're somewhere in the back half, if not later innings of this interest rate tightening cycle that has created this volatility and this angst amongst the investing public.
Yeah, no, great point. I think Morgan Housel has this great quote where, every recession ahead of time looks like this, insurmountable obstacle. And, without fail, every recession, market correction, in hindsight turns out to be a fantastic opportunity. So, it's trying to obviously, position your personal financial situation in a way that, you can take advantage of that opportunity, or at minimum, not, expose yourself to unnecessary risk. But we will get through this. Like you said, if it's a slowdown, if it turns out to be a significant recession, it certainly won't be the first recession. It certainly won't be the last. And sooner or later, the news cycle will kick into gear, and we'll be talking about all-time highs at some point in the future, whether that's this year or next. That will come. So
yeah, and you mentioned the all-time highs, but here's what a lot of commentators that you'll see, they're going to try to coach you to find that ultimate low, the low point of where the markets have maximized, the full drawn out recession. That's a fool's game to try to pick the bottom, just like it's a fool's game to try to pick the top. You look at this and say, where can you find good value amongst various asset classes again? And if you got a company that, was in 2021, early 2022 was trading at a rich valuation, and now that valuation has been cut in half by, cut by 25, 30, 50%. That's when it's a good time as an investor to say valuations or multiples are attractive. Is that an opportunity to start accumulating stocks, as opposed to saying, I'm jumping in because now I predict the low because the markets tell me that's the low? That's a fool's game.
Yeah. So running out of time a little bit here, let's move into a couple of predictions each of us have for the year ahead. Clark, what are you seeing out there that you want to share with us? And we'll put your name, and we'll have to wager a bottle of wine or something for I guess the person who's most right, or maybe the person who's most wrong for the next 12 months.
That last bet we had, Jay, which is still outstanding, but and it was for a bottle of wine, if I'm not mistaken. It looks like I could be the winner of that, but
you got some equity to work with.
Yeah. Okay. So I've got a few predictions for this year, and I think they're kind of all in line with what we're talking about. I think inflation being, probably the biggest topic today. I think it's something to note. I do think inflation has peaked. I think as we look forward over the next 12 months, I think what may surprise the market is how quickly inflation dissipates. I'd make a call that potentially this year that we see inflation numbers being back within what is the targeted band by central banks of 2 to 3%, potentially lower than 3%. I think at some point in the future, I wouldn't necessarily say this is a 2023 prediction, but I think that the D word, deflation, will be back on the table as we undergo an environment where we have price pressures on the negative side as well. Again, that's not my call for this year, but I think inflation dissipating quicker than the market expects into levels lower than what the market expects, kind of back into that band at the central bank's target, 2 to 3%, is what I predict for this year from that perspective. I think there's a couple caveats there, though. I think where could that go wrong? I think one is
no caveats. This is just simple predictions.
No, I'll give a couple caveats. So just
no hedging your bets. No hedging your bets.
No, I think that the supply shocks, which we talked about, which were the primary factor really for this inflation. We could, unfortunately, maybe COVID rears its ugly head again, and we get back into areas like China, even North America, having shutdowns again. I don't see that, but I think that continues to be a risk to some degree. I also think government policy. I think we have governments around the world continuing to want to provide stimulus. We saw yesterday, I shared this with Craig. I came across a Twitter headline that, let me just see it here. It was, if you have a direct deposit set up with a Canadian revenue agency, you may see some extra money in your bank account, and the provincial government says you can expect more help in the future. David Eby, our new premier, went to Victoria, I guess it was a month or two ago, as a new premier, and I think he brought a couple of things with him. I think to some degree he brought the printing press with him again, and I think he also, brought an old university textbook about economic and political systems, where, I think we're kind of looking at things the wrong way. And I'm not arguing that money, there's not some people that are not in need because of inflation, but providing checks over the next few months of $300-400 to 85% of the families in BC, although that might be needed in some areas, that is potentially adding fuel to the fire again. That
Yeah,
creates
that's
demand.
inflationary. It's in its own right, is it not? Like, that's exactly what you're trying to go against.
Yeah, so human nature is when you're given that money, you go out there and spend it, which is inflationary. So I think I'm just using that as one small example, but we do see that sort of political mentality, throughout North America and the world, is continue to print money. I don't think it's needed when you're trying to actually fight the effects of printing too much money as a catalyst to a difficult period, such as COVID. So that's the first prediction with those few hedges, as you say, Jay.
Neutral.
In turn with that, I think that if we do see inflation moderate, interest rates will decline. We're starting to see that. So I think that some of the better performing asset classes will be the long dated assets, long-term bonds, but that also translates into equities, companies whose valuation is based on profits in the future, some of the technology stocks, things like that. And third prediction would be, I see 2023 potentially being a year that international markets, particularly emerging markets, could outperform. Keep in mind that everything that we've seen over the last few years, a strong US dollar, high energy prices, high inflation, et cetera, affect emerging markets the most. If we start to see these things dissipate and these trends reverse, we should expect what were significant headwinds to emerging markets to become significant tailwinds. So I think a chance for emerging markets and international markets to outperform.
Well, look at some of the top performing markets by geography this year. European markets, in particular, European banks. You look at emerging markets; they're the top performing because you've seen some of that, some of the weakness in the U.S. dollar over the past month or so. So if that trend continues, I think that's a pretty good bet. Now, let me ask you one question, Clark. You say you think you see interest rates coming down. What do you think is the driver of that? And that's a pretty big 180 from the rhetoric right now amongst leading central banks. They're pretty hell-bent saying, 2024 at the earliest is when we're going to start looking at that.
Well, I think your point's well taken, and I think that's where do we see interest rate decreases? So you pointed out earlier, we've seen the 10-year go from 4.5 back into the mid 3s. Whereas on the front end of the yield curve, we continue to see rate increases, which are dictated by policy change by the central banks. So what I'm referring to mostly is how the bond market is adjusting intermediate to long-term rates. Now, that being said, I think your point's very well taken, is that I would be surprised to see the central bank rates, so those that are on the short end, moderate much. I think your point earlier, which is we will see them, decrease much, we'll see them moderate. I think what's different this time around relative to other periods of weakness, where central banks, their first reaction is to cut interest rates to provide stimulus. They continue to have inflation on their mind. So even if we do get into a period of economic weakness, they're going to be on a relative basis far less likely to decrease short-term interest rates. I think we'll ultimately see it maybe at the latter end of this year, where central banks may see an environment where they do need to start to drop those rates. My point is mostly in the bond market, though, on intermediate and long-term rates.
Yeah.
Nice. Craig, what do you got for us next year? What's happening?
Yeah, I kind of, as you warm me up to this, maybe I'll take a bit of a tangent. I think what you've started to see in the last 6 weeks, couple of months, with the cracks starting to emerge in cryptocurrency, with what you've seen with FTX and Sam Bankman-Fried, who's, looks like, he'll end up somewhere in some sort of prison at some point, and we won't find that out probably for at least a couple of years. This will probably be one of the most long drawn out trials that'll catch a lot of attention. But kind of like when you throw a rock into a pond, it takes time for that ripple effect to come out amongst the shadows. I think you're going to start to see that within the crypto space. Now, I'm probably going to get a lot of people calling me out on that, and I'll say I still believe blockchain technology is something that's going to remain part of the future, but I think cryptocurrency is, they may use this FTX case as example for new regulations going forward in that space, which is highly unregulated. And you're starting to see comments from that from government officials. And you're probably, again, 1 or 2 announcements away from any sort of regulatory commission or body saying, you know what, we're going to start regulating it. And then all the secrecy behind these cryptocurrencies, if those ever get unveiled, I don't know if I'd want to be an asset or an investor in anything related to that sector. So, you know, I would watch to see if you continue to see more cracks emerge on that space, which, again, 12 months from now, if this is a prediction on a calendar basis, we'll see.
And I think to our benefit is, you know, we're not so interested in using those tools. You know, in my perspective, the more money that comes out of, you know, internet money, cryptocurrencies, comes back to, you know, legitimate use in capital markets and for investment in, you know, profitable business and in ventures. And I think that's a much healthier use of capital than this diversion we've all been witnessing over these last few years.
Yeah, I think it's a great point, Craig, about cryptocurrencies. You know, although we could have made that prediction in 2018, 19, 20, 21, and, you know, we saw money flow into those kind of asset classes on a speculation basis. But we've been talking about this for a number of years. I think it's not a matter of we've been wrong. I think it's a matter of we haven't been right yet, in a sense. And I think these sorts of, I don't know if fad is the right term, but those asset classes or speculations that it's like, you know, tulipmania in a sense that people run into with this belief can tend to last a lot longer than we think they can. And I think your point, though, we are starting to really see the cracks now. And I agree that'll continue in 2023.
And I think what's different this time, too, that a great point about 2018-19, you didn't have a $44 billion evaporation of capital in a matter of hours. And I think that is a total game changer in that space.
Yeah.
Jay,
anything else,
what do you
Craig,
think
as far as predictions for this year?
Come on, Craig, give us something interesting.
You want another one?
Stick your neck out.
You know what? I wouldn't be surprised too if you maybe start to hear a change of tone amongst North American governments who are so supportive of green energy, which I am too. I think everybody on our team agrees that, you know, green energy is the transition we want to get to. But you look at some of the challenges that, in particular, the U.S. has had with elevated gas prices, whether it was releasing oil from the Strategic Petroleum Reserve, whether it's the challenges that you're seeing with weather-related events, whether it's the challenges in Europe with their transition to solar and wind energy, which didn't create the energy that they needed. I wouldn't be surprised if you start to hear, you know, more of this energy independence and small snippets of supporting more exploration and production in a clean way. So we are, again, less dependent on global oil prices.
I like that.
That's a one-off, and I know that's probably going to create some controversy as well. But, you know, the Biden administration was put in a tough spot when oil prices were elevated, and look what they did. They went to the last resorts and dip it into their own pool to keep prices depressed. And, you know, how do you continue to do that if you get another spike in oil? And if you talk about, Jay, if you get China back online, well, that's demand. That's more pull on production. So how do they offset that?
Yeah.
That is a controversial topic. I mean, we might as well just be talking about politics and the U.S. election and Republican Party or whatever it might be. So let's throw Trump in there.
Save that for podcast number 2.
Okay.
Yeah. I'll throw a couple out there. I'll play the contrarian and I'll say that the year ahead, where almost again universally the expectation is for the continuation of high volatility. and maybe I'll take the benefit of being, 10 trading days into the year and seeing a little bit of a trend start to emerge. But I'm going to say this year ahead, we're going to see a lower volatility environment. However, that's gauged by, less greater than 1% moves on a daily basis, or less drawdowns, whatever it may be. I think we're going to look back at 2023 as a much lower volatility in the market year than certainly expectations, and maybe just relative to most years in general. And again, that's just a pushback on what consensus is prepared for. And as we all know, the market does a great job of fooling seemingly the most amount of people at every opportunity. So I'll stick with that. And then I'm going to say this year, we're going to see a technical recession. They're going to call it a recession, but I'm going to combine that with the markets, both the TSX and S&P 500, ending the year with positive returns. So those are my 1 and 2, and the recession and a positive return I'll combine as kind of one prediction that is a little contrarian as well.
I like it. Okay.
Well, we've chatted on here about just about an hour here, and I think that's probably as much as our listeners are willing to tolerate. Again, I hope everyone found something useful, interesting, from this conversation that we've had, and I've enjoyed it. I certainly hope we can churn one of these out on a regular basis, and discuss what's happening in the world, and hopefully future conversations contain a little bit more information when it comes to some of the other things that we try to provide for clients, whether it be on the topic of taxation or estate planning and that sort of things. I think that's kind of the objective that we're aiming for. So again, we welcome any feedback, anything you'd like to hear us discuss. You know how to get a hold of us, and we look forward to carrying on the conversation with our clients. That's all for now from Plena Wealth Advisors.